I guess we should start with the Fed, of course. Someone actually described it to me as a back-to-school September rate cut. It feels like the entire market has just opened at the idea of a September cut with pretty much open arms.
I think that's right, Katie. Thank you. Thank you for having me. I think it's really about that back-to-school cut. It's almost the school kit where everybody is widely anticipating and knows what's going to be in the kit. I think many are going to look to this week as a bit of a dovish hold from here, and they're looking to hear from Chair Powell. What are we doing next? What are we doing next? And it's unlikely that he indicates the timing, but I think it's clear that he's going to follow the narrative that the data is breaking in a direction in which September seems likely. It's fully priced in almost at this point into the market. Now, looking beyond that, the market's getting a little bit ahead of itself in terms of the magnitude of cuts that are priced in thus far this year, but certainly remains a lot to be seen, and we'll really be looking to the statement and the presser this week to get a bit more of an indication of where we go from here.
And what specifically will you be looking for, will bond investors broadly be looking for when we finally get to that statement, and then also when we actually hear from the man himself at 2:30?
Well, I think we all love hearing from the man himself, because that's the moment in which you expect that the narrative might shift a little bit differently than what we've heard thus far from Fed officials, and just, I think, a bit more of the certainty of the statement. And so at this point, if you look at what's priced in thus far this year, it's nearly 3 cuts between now and year end. So the market is really poised for this idea that the Fed message will be dovish, that it will be dovish. So if you get anything different from that, I think the market would be surprised by any type of hawkish messaging from here.
I just want to bring everyone some breaking news in terms of Treasury refunding and the borrowing announcement. So the U.S. actually cut its July-September borrowing estimate to about $240 billion from $847 billion. Then from October to December, it's looking to borrow about $565 billion. Now we're going to get where they're going to issue on the curve on Wednesday, but now we have the total amount. We're looking at that estimate coming down to $740 billion from 847, which kind of then pairs into what we're expecting in terms of the curve. Like, where is the massive amount of borrowing that we were expecting that's going to keep those high-end rates higher for longer?
Yeah, so number one, the market's going to like that refunding announcement is less. So that certainly gives some added fuel for rates to continue to come down a bit further. We saw a significant bull steepening last week. And then I think what the market's going to want to see is where on the curve. There's tremendous demand on the front end. Look at money market funds, $6 trillion in assets today. That's astonishing. And so what you've seen the Treasury able to do is really lean into that. It's those points in time where we've had fear and concern that refunding was going to be the longer end of the curve, that it's led to that bear steepening. So I think we're going to really be paying close attention to Wednesday and where on the curve you should expect.
So do we think that we're going to see that bull steepener continue, where you see the front end continue to bid and those front end rates come down? Or do you think the steepener where we see the long end sell off continue?
So it's really, again, it's dependent on so many factors to unpack. So let's unpack that. When we're talking about the direction of travel for the Fed, that lends to the front end coming down faster, right? And you continue to get that bull steepening impact. Other factors that we're thinking about, of course, is the refunding. And if you get to a moment in which people start to take a step back and look past the near-term expectations of the Fed, or some of the factors that we're thinking through with the election, and you look further out to deficits that are rising, then you have the potential for some pressure on the long end. But I think for now, expect some stabilization from here.
And it seems like when we're talking about the deficit, and we're having this conversation with, 99 days to go? I think it's 99 days until...
That is quite a countdown clock you're going to start.
I have it just, burned in my brain here. But it seems like no matter what happens, who takes control in November, that one of the things that you can bank on, forgive my phrasing there, is basically that the deficit is going to continue to grow from here.
That's right. That's right. I think we agree, regardless of the outcome of the election. And I mean, 99 days doesn't sound that long, but there's a long time and a lot that can happen in between. Deficits are going to impact markets on a go-forward basis, so you need some level of fiscal restraint. Whether we get it on a go-forward basis is a differing issue. Near-term, medium-term, long-term, I think of the deficits as having a meaningful material impact over the medium and the long term. In the near term, I would be more focused on slowing growth and where we head from here, cooling labor markets, where we head from here, and also a Fed that has been clear there is a path towards further easing. The gap between Fed funds rate, CPI, and PCE is quite wide versus the historic norms if you go back to the early 70s. So there's a lot of room here for additional easing. Do we get it this year? Absolutely not. But does it seem likely over the next 12 to 18 months that the key driver of rates is going to continue to be the Fed and their action? Yes, I think so.
Well, just quickly, I don't know about you, Alex, but when it comes to the deficit, the question that I always tend to ask is, can you invest around it? What is investable around it? Because we were having a conversation with Steve Eisman a few weeks ago, and he calls them the deficit people, that it's always this big issue, but when does it actually, and where does it actually show up in markets?
I think the deficit, can create some opportunities and volatility. We saw that in the third quarter of last year, in which all of the bond vigilantes demanded higher rates, and we said this is an opportunity to add for long-term investors to duration. That reversed in December. If you look at the market right now, we are looking at where are the best opportunities within fixed income. If you are a tax-paying investor today, then you want to be in the municipal market. Plain and simple. And if you really look around, you want to be in higher yielding municipals. Plain and simple. Why? Well, yield is now going to be a key driver of returns on a go-forward basis. High yield muni indices, 545 tax exempt yield. That's 9% plus tax equivalent. Well beyond what you can source in the corporate market. Meaningful spread, nearly 190 basis points versus investment grade muni risk. And then you layer on top pretty strong credit fundamentals and backdrop in the space. I think it's a really wonderful opportunity on a go-forward basis. And yes, rate volatility will matter, but it's looking into areas of the market that remain attractive in terms of all-in yields, tax equivalent yields, and then of course with resilient credit fundamentals from here.